So I'm going to talk about limited companies for GP practices, not for actual individual partners, which was something that we talked about last year, but actually for running the GP practice through. And this seems to be something that we are getting asked more and more questions about, partly, I think, driven by practice issues with the moment, particularly regarding GP recruitment. And there's lots of misunderstandings regarding how the limited companies may work for operating a GP practice. So I'm just going to go through all the issues or the main issues that we need to consider if this was going to be something the GP practice was going to consider. Now, as you probably all know, most GP practices operate as a partnership. And that does mean that the partnership, or all the partners in the partnership, have joint and several liability for anything that happens within that partnership. So, for example, if one of your partners did something discriminatory against an employee, for example, then all the other partners in the practice would also be liable for that. And that does create a cause for concern for some partners, and particularly regarding new GPs that may become partners. So the thoughts behind a limited company are that perhaps it may help with GP recruitment, mainly because of this liability issue. So there can be a restriction on personal liability if a business operates through a limited company rather than through a partnership. There is also often the perception that if you operate through a limited company, that you will pay less tax. And this is kind of a myth, really, that's born out from perhaps people speaking to colleagues at the hospitals or the man in the pub saying, oh, I've gone through a limited company and my accountant has saved me lots of tax. Well, that doesn't necessarily happen. It can happen in certain circumstances, and I will go into that in a little bit more detail in a moment. Operating through a limited company will reduce the pension growth, undoubtedly, because the company will pay tax before any income is left to distribute to directors. But that may not be such a driving force now for going towards a company, as some partners may not be overly worried now about reducing their pension growth due to the changes in the budget regarding the annual allowance and lifetime allowance. So the risks regarding that are reduced, and I'm sure that Steve will be going through that in a bit more detail later on. And there will also be potentially operating through a limited company will lead to reduced pay disclosure. So some GPs were required this month to declare their pay under the pay transparency rules, and obviously there are lots of issues regarding that and whether it's the right or wrong thing to do, but it would reduce that figure for GPs if they moved across to operating through a limited company. So let's just kind of go through some of those issues and say, actually, what would the impact be, and are they as good as they may first appear? So looking at any personal liabilities. So yes, operating through a limited company would undoubtedly reduce the risks for directors. So the partners would essentially become the directors of that limited company. However, it may not entirely make running a business risk-free. Operating through a limited company may mean that there are still personal guarantees required from the directors, and the main areas they may be required for is if the practice is renting a building, so from a landlord, the landlord may require personal guarantees from the individual directors. Obviously, moving from a partnership lease to a lease with a limited company, the landlord may not automatically agree to that and may actually want some reassurance that the rent will still be guaranteed going forwards. Personal guarantees may also be required if the practice has other finance, so if it's taken out some finance to buy fixed assets, or if it's borrowed additional money from the bank in terms of a loan or an overdraft, those lenders may still want some personal guarantees from the directors. So it's not all going to be risk-free through a company. And besides any personal guarantees that directors may need to provide, directors of a company can still be at personal risk. So there are certain circumstances when directors of a company can be liable. and there could be a claim against their personal assets. So that may happen if staff or directors within the company have been negligent, or if the company's continued to be operated when the directors know that it's insolvent. So it's not all plain sailing. A company will reduce the risk, yes, but it won't get rid of any personal liabilities entirely. So what about the tax? So this is a really difficult area to advise on, mainly because every person's individual circumstances are so different and there isn't one size that fits all. So it can be possible to save tax by operating through a limited company in certain circumstances. And that's very important to remember, that it is in very certain specific circumstances. So the main ways to save tax by operating through a company are to leave some profits within the company and actually don't withdraw all of them, or to involve other perhaps members of your family who are lower taxpayers. So that may be a spouse, it may be adult children who are at university, and that type of arrangement can work well if GPs or other medics have private income. But it may not necessarily work so well in a partnership, moving to a limited company where each individual director will have different circumstances, different viewpoints, different requirements for finance. So it would be quite difficult if there are several partners with all different viewpoints trying to get that to come to some sort of agreement between them on how they withdraw money and whether they actually involve any family members. On top of that, you may know from the budget that actually corporation tax has increased significantly with effect from the 1st of April. Now, a company is a completely separate entity on its own account. So if a practice does move across to a limited company, the partners need to remember that that limited company, the funding within that does not belong to them. So the company will make a profit, and before any money can be paid out, normally as dividends to the directors, the company would need to pay tax on that profit. Now, the corporation tax rate increased from 19% to 25%, so that's a massive 6% increase. The old 19% will still apply for smaller companies who have profits under 50,000, but most GP practices aren't going to be within that band. And they will be falling within the 25% rate for corporation tax. So the company pays the corporation tax at 25%. Whatever's left over after that can then effectively be paid to directors, mainly as dividends. There may be scope to put a small salary through for directors, which would be deducted before calculating the corporation tax. Normally that's done so that directors can maintain their entitlement to state pension, so that salary would normally be set at the minimum rate to qualify for national insurance credits. So if we look at the money going through the company on top of the 25% corporation tax, let's assume that the director is going to withdraw the rest of the money as dividends. If the directors are highest rate taxpayers, which would mean currently they pay tax on their partnership profits at 47% at their top rate. When they draw dividends out from the company, there would be income tax on that at 29.51%. So the overall top rate of tax, when we take into account the corporation tax, would then be 54.51%, which, as you can see, is significantly higher than the top rate of tax of 47%, which would be payable if the profits were dealt with through a partnership. If partners are higher rates, so 40% taxpayers, that dividend rate reduces from 29.51%, and their overall tax rate would then be 51.3%. But again, that's still significantly higher than they would be paying as a 40% taxpayer through the partnership, when the overall rate, including national insurance, would be 42%. The other thing to think about as well, for partnerships that have non-March year ends, is what would happen about the change of basis. So Rob has just gone through details of what the additional tax may be for practices with non-March year ends who are going to effectively need to be moving to a March or 5th of April year end for tax purposes. Any additional tax generated as a result of that move can be spread over 5 years. If a partnership in that position decided to become a limited company, the partners would lose that ability to spread the additional tax over 5 years, and all of that tax would become payable at once. So that's something else to think about if the practice has a non-March year end. That obviously wouldn't apply to any partnerships that have a March year end. So that deals with the tax, and there's lots of calculations that need to be done to show individual circumstances how that would apply. So please do get in touch with one of your contacts at Mentors if that's something that the partnership do wish to explore further. Moving then on to the case of the pensions. So if a practice operates through a limited company, there will automatically be a reduction in the pensionable pay of 25%. And that is because the company will be paying corporation tax at 25% before any profits can be distributed to the directors. So that may be good news from the viewpoints of some partners. They may want to pay less into their pension. Excuse me. But in terms of the annual allowance and lifetime allowance issues now being reduced, partners may not be so incentivised to do that anymore. And it needs to be remembered that if partners are paying lower amounts into their pensions, they're actually going to get less out when they come to retire from their pensions. So that may not be an area that partners actually want to pursue anymore. In terms of the annual allowance and lifetime allowance, in the budget, it was announced that the annual allowance will be increasing from 40%, or has increased from 40,000 to 60,000 in April 23. And while that may reduce the scope of an annual allowance charge for some partners, there may still be partners where they will have a charge, but it does help, and it will significantly reduce the number of partners who have an annual allowance charge. We also found out in the budget that the lifetime allowance is effectively being scrapped. And again, I'm sure Steve will cover this in more detail later on. But that does mean for some partners who are at that lifetime allowance limit that actually that's not a concern anymore. However, obviously we do not know what's going to happen if there are, or when there are, any changes to government. Labour have indicated that they will probably bring the lifetime allowance back in. So the impact of not having a lifetime allowance may be something that's short-lived, and we'll just have to wait and see what happens with that. Now, the main area where we're looking at potentially moving to a limited company that causes concern, and it's the same issue if practices are looking at merging, is that of property. It's really difficult to look at, to come to a consensus for all partners of what's actually going to happen in terms of properties, and how to deal with this going forward. And mainly because there are lots of different options. There are different ways that practices own the property or lease it, but also because there are massive amounts involved. There can be multi-million-pound properties within partnerships, so it's important to consider all the issues and try and get that right. So if the property is currently owned within the partnership, then there is an option to sell the property across from the partnership to the company. But that can lead to tax issues. So on selling the property to the company, there's likely to be stamp duty, land tax payable by the company on buying the property, and also the capital gains tax on the sale of the property will be crystallised and be payable by the partners. There's also likely to be higher capital gains tax payable by the partners, because they will not be entitled, or they will probably not be entitled to the lower 10% rate of capital gains tax, and will probably have to pay 20% capital gains tax. Once the property is in the company, should the company sell the property in the future, the capital gains tax under current rates would be higher. And that's because a company pays capital gains tax at the rate of 25%, but partners pay capital gains tax on business property, mainly at 10% and in certain circumstances at 20%. And there's also no personal allowance within a company for capital gains tax, whereas all partners at the moment have a capital gains tax allowance of just over £6,000. On selling the property to the company, there may also need to be additional work done regarding refinancing or obtaining agreement from the lender about moving the property across, and there may need to be some personal guarantees and additional legal costs in connection with that. An alternative to moving the property across could be to retain the property within the partnership, and then the limited company lease the property from the partnership. The downsides of that is that the lower 10% rate of capital gains tax would be lost, and all partners would be chargeable to capital gains tax at 20% at current rates. There would need to be a lease approved by the ICB because the property would be rented from an external landlord. There would be additional legal and stamp duty costs of setting up that lease. And longer term, it could create issues deciding on the future of the practice, because property owners and the business owners would be different. And over time, the property may start to be owned by people who have no connection at all with the company. For example, if a property owner died and left it to their children, you may end up with property owners who want to sell the business, but actually the GP practice is keen to continue renting it. If the property at the moment is leased through the partnership rather than owned, that lease would need to be transferred across to the limited company. And again, there would need to be ICP approval to do that. The landlord would need to approve the lease to be moved across. And there would also be additional costs involved in doing that, and potentially, again, personal guarantees required by the directors. So what could be the alternative to moving across from a partnership to a limited company? To try and help with recruitment issues, partners could look at trying to recruit non-GP partners, and we are seeing more interest in this, looking at practice managers, nurse practitioners, pharmacists, etc. Partnerships who own a building could look at potentially doing a sale and lease back. New GP partners do seem to see this as less risky, although they are still liable for the long-term rent. But it can be more appealing to new partners and gets around the issue of those new partners having to raise any finance. Partnerships can look at trying to reduce any capital buy-in for new partners, so whether that's related to the property or related to current account requirements. So that could involve refinancing perhaps before a new partner joins, or drawing out some more money from partners' current accounts to reduce their balances, always bearing in mind, of course, cash flow issues. Another alternative could be perhaps merging with another practice. The idea behind that is that the more practices, more partners there are, the less risky it becomes. Other issues to think about in terms of a limited company are you would need to obtain the ICB approval to moving the contract across from the partnership to a limited company. And that comes with the risk that the contract may need to go out to tender, or the ICB may insist that you move across to an APMS contract rather than your current PMS or GMS contract, which then would be time limited. Other issues for the limited company are loss of flexibility, so particularly with regard to partners coming, joining and leaving, partners changing their profit shares, partners' prior shares. It can be dealt with through a company, but it becomes much more complex. And partners have to basically stick with what they're doing. It becomes really difficult to account for changes in profit shares and partner session changes. All the staff would need to be 2P'd across. CQC registration would need to be applied for, and any accounts regarding the limited company would need to be submitted to Companies House within 9 months of the year end and would be publicly available. At the moment, the amount of information that's submitted to Companies House is reduced. It's not as much as included within the partnership accounts, but there are proposed changes regarding that going forwards to provide more information to the public. There are likely to be additional costs in connection with running through a limited company and moving across to a limited company, and these could be fairly significant. They could run into thousands and thousands of pounds. The practice would need to take advice from the solicitors at an early stage, and there could be additional costs involved in transferring the properties, setting the company up, setting up a shareholders agreement, which is similar to a partnership agreement, but really does need to be done at the very start, and also dealing with the 2P of the staff. Accountancy costs would include advice regarding sorting out property at the start, any other advice, and then also operating through a limited company is more expensive, so the ongoing accountancy costs would be more expensive. Operating through a limited company would also involve additional costs. So that would involve an extra administrative burden, perhaps for some of the staff, but perhaps involving the accountants as well. That would relate to keeping detailed minutes of directors' meetings, preparation of dividend vouchers, approval of dividend declarations at directors' meetings, dealing with share transfers, dealing with submissions to Companies House, including an annual confirmation statement and submission of the annual accounts. And there would be other administrative issues on setting up the limited company to do with things like changing the supplier contracts and changing the lease agreements, for things like phone systems, photocopiers, those sorts of things, setting up bank accounts and making sure that all the direct debits and standing orders, etc., were set up properly and moved across. So in summary, a limited company could potentially work in some circumstances, but it's not straightforward. The tax savings are not necessarily there, and it may lead to significant additional costs, particularly regarding the initial setup of the company. If practices are looking at this option, I would advise them to take time to consider it. Please do not rush into it without taking any proper professional advice. And make sure if you do move across to a limited company setup, that the company is set up properly from the first instance. Please do not go on to Companies House and set up your own company for £50 or whatever the cost is these days. Please make sure you take some advice, get it set up in the first place, because actually it's cheaper in the long run to get the company set up properly from the start, rather than set it up wrong and then have to go through and try and make some amendments after to get it to come out how you need it to.